Today we're going to talk about Roth conversions or not the Roth.
Well, to Roth or not the Roth, that is always the question. The vast majority of the time when I try to do a Roth conversion analysis, I think it works. There are times, however, when a Roth conversion does not make any sense at all. The reality is there is software out there, financial planning software, that I don't think necessarily always tells the full picture of whether or not a Roth conversion makes sense, because it's not thinking of some of the things that you as a CPA think of. What is your take on the Roth IRA? I still think it's the best tax code ever written.
It is. But, and I don't want to say but the problem is back to the financial planning software. Now we have tax rates in the financial planning software that are permanent. Every time they're permanent, since 1913, they've never been permanent. So,
right. Because they always change. Congress is not going to keep their hands off of it.
So you still got to be looking forward to, outside of the math, you're looking at life events. What happens if, I just normally take a certain amount of my IRA and it's going to keep me in this bracket, but then I have a need for some money and all my money's in pre-tax. And I've wasted tax bracket and opportunities along the way to actually create that pool of tax-free money. Now I'm going to blow up my tax bracket and end up with like IRMA. If I had medical expenses, I'm going to lose some of those because my adjusted gross income is now higher. Not only looking at the math, but also looking at, life events.
The first reason is the math says you don't need to. The second reason is your beneficiary of your IRA is a charity. Well, you don't want to convert to a Roth if it's a charity. Surviving spouse will not be burdened with higher taxes in the event that they become a single taxpayer. You are charitable and need pre-tax dollars to fund your QCD or your charitable contributions. You are your heirs in a low tax bracket and can easily liquidate the IRA within 10 years without substantial tax consequences. You're retiring soon and you've planned to make your tax rate lower, making Roth conversions early in retirement. So, in other words, don't convert now, but maybe wait until after you retire. And then you're retiring soon and moving to a lower or no tax state. It says the math says you don't need to convert. And outside of the math, I think you have to also consider when you might need a larger distribution at some point in the future. So I think you have to approach the Roth conversions 1 year at a time.
Absolutely.
Based on the information that we have at that point.
Yeah.
And not about a break-even analysis, it's about a probability of success analysis.
Exactly.
Yeah, there's a lot of assumptions. And when we talk about doing Roth conversions, we always say, don't go out and blindly do a conversion just because you've heard the thing that you should do a Roth conversion. Sit down and understand all of the facts, know exactly what it's going to take in order to get it done, and know exactly what the benefit's going to be on the other end. I mean, you guys as CPAs, you're getting down to pennies here on what you should convert, not just saying fill up this bracket or fill up that bracket.
Yep, exactly. Because you're looking at everything else. You're looking at the life events. You're looking at the other stealth taxes, and some of the stealth taxes that I'm trying to offset in the future, because they may never raise tax rates, but they sure have a lot of different ways to increase it with phase outs and additional, taxes that we see right now.
I gave that example earlier, Marty, about the lady who has gone into a continuing care retirement community. She got a deduction on a portion of her buy-in or a monthly for this year. This was the first time she got her total deduction for health was about $90,000, right? I think 93,000. And so her initial thought was, well, I should convert 93,000 from my traditional IRA to my Roth IRA. Well, we sat down, and of course, the CPA here in our office in Lenexa had everything in the tax software. And he said, no, your number that you can convert is actually right at about 50,000. And she was like, I don't understand. And he said, well, you have $15,000 of capital gains that if we convert 93,000, all of a sudden that $15,000 of capital gains is going to be taxable at the 15% rate, where today it's not taxable at all because of where your income falls. And oh, by the way, if we convert to 93,000, it's going to be $200 a month more for your Medicare because of the IRMA bracket that you cross into. Yep. And so that extra like $37,000 was an effective rate of about 35%. Well, it doesn't make sense to go there.
Exactly. I mean, one of the strategies is actually, if you don't have long-term care insurance, if you haven't transferred the risk to an insurance company, and I've got pre-tax money in my IRA, I'm going to generate some form of a medical deduction more than likely in that long-term care event. And so it's going to take some of the bite out of it. So that'd be one reason why I wouldn't want to convert everything I have, and that's where I keep coming back to. You figure out how much do I need to convert to accomplish what I want.
Exactly right. So let's go on to reason number 2, why we wouldn't want to convert to a Roth IRA, and that is if you have a beneficiary of your IRA that is a charitable organization. Now, Marty, I'm working on a scenario right now along with Corey Holstein, who's been on here on America's Wealth Management Show many times before, a cohort of yours, a CPA. And we're working with a client and his spouse. They have about $5 million in IRAs. They're in their mid 60s. They have no children.
Yeah.
And in addition to the $5 million they have in IRAs, they got about another $10 million in liquid assets, and just the dividends and interest off of that take care of all of their needs and living expenses. And so, we're asking the question, well, should we do a Roth conversion? Well, this guy happens to be very charitably inclined. And I'm like, well, why wouldn't we just set up a family foundation and have that family foundation be a 501c3 organization, and then name that family foundation as the charity and let your nieces and nephews dole out the money to charities after you're gone?
Yeah. And the person who doesn't have that type of money could actually do that with a donor advised fund.
Exactly right. You name the donor advised fund as beneficiary, right? Yep. There's a number of different things that you can do there. But if if you have any kind of a charitable organization or charitably inclined, obviously don't convert that to a Roth, because the charitable organization gets the money and they can get it and cash it out, use it, whatever, and don't have to pay taxes. The number 3 reason why you may not want to convert to a Roth IRA, and that is if your spouse would not be burdened by higher taxes in the event they become a single taxpayer. Say that in English for people that don't understand what that means.
So there are some advantages to being married and filing a joint return for a lot of people. Some people, maybe not. But for generally, there are some advantages to that. But then when one spouse dies, and of course that year that they die, I'm still filing a joint return. Following year, that spouse is now filing single as a single taxpayer, where a lot more things your standard deductions are compressed, your IRMA thresholds are more compressed. The fact that my income may even go down, but my spouse could end up in a higher paying more taxes than she would have if we were still married. So literally what you're doing, we run this scenario in the tax planning software, we're going to kill one of them and say, here's what this looks like, and say, okay, so maybe we want to have the Roth.
In most cases, Marty, we see that single payer paying way more taxes on the similar amount of income that they would have been paying as a married filing jointly. And it's like, oh my gosh, so what can we do about that? Well, we can consider doing Roth conversions. Yeah.
And sometimes that deathbed Roth conversion is the thing to do.
But not always.
Not always.
Right? You got to run the scenario one at a time, and they have to all play out. Another one here, Marty, is 3 letters, QCD.
The holy grail of charitable contributions.
Yeah. So you may not want to. Now, this doesn't mean you don't want to convert anything to a Roth, but you definitely would not want to convert everything to a Roth if you are charitably inclined, because of those 3 letters. QCD stands for what?
Qualified charitable distribution. This is where I'm 70 and a half, like not before, but 70 and a half. I start sending my charitable contributions directly from my IRA to the charities I want it to go to. Now, it can be made out to the charity and mailed to me, and I can go drop it in the plate. But as long as it goes out that way, it doesn't show up in my modified adjusted gross income, my adjusted gross income, or anywhere on my tax return. It shows as a distribution, but the taxable part of it would be 0.
So it's better than getting a deduction for a charitable contribution.
Absolutely. Because that's an itemized deduction. And people don't forget, because we have a lot of people who are getting inherited IRAs right now. If I'm 70 and a half and I have an inherited IRA, I can make my QCDs out of it also.
What about those people out there, Marty, that have separated service from a company but didn't want to roll their money out of their 401k plan to an IRA? Can they give the QCD out of the 401k?
QCDs only work for IRAs.
Okay, not even SEP IRAs, just a regular IRA?
Well, you could do it out of a SEP IRA because it's technically what I call a glorified IRA.
Just one that you can get a little bit bigger money into if you're a self-employed individual.
Right, but a regular employer plan, you cannot do your QCDs out of there.
Yeah, so and the QCDs...
and it helps satisfy your required minimum distribution for the year.
Number 5 on our reasons why we may not want to convert: if our heirs are in low tax brackets and they can easily liquidate the IRA within the 10-year window without substantial tax consequences, it may not make sense, right? Especially if you're in a low bracket and your heirs are going to be in a low bracket, and if you start to convert, it pushes you up into a higher bracket. That may not make sense.
Right. So you're really looking at the total family dynamic there. Also,
Which you should.
Yeah. And where do the kids live? Are they in a no tax state? and my, I really have a desire for more of a legacy. You're factoring all those things in as to, do I do the conversion or can we just, pass this along? The other thing, if I already have a Roth IRA and I have a traditional IRA and I have one child that is a higher income tax bracket one, the other one is a lower income tax bracket one, maybe I want to shift who gets what money to maximize the amount of legacy going to the family.
The views expressed represent the opinion of Modern Wealth Management, LLC, an SEC-registered investment advisor. Information provided is for illustrative purposes only and does not constitute investment tax or legal advice. Modern Wealth Management does not accept any liability for the use of the information discussed. Consult with a qualified financial, legal, or tax professional prior to taking any action.